Okay, going to go through this again real quickly so that everybody's on the same page when it comes to the structure and the flow of this process. So you start at the LLC level, okay? And so you create an LLC. If you have an S corp right now, then you need to change it or convert it into an LLC. And that's a simple filing with the state, the Secretary of State's office, and that's all that's needed. The LLC is going to receive money. So let's say it's $1 million in a given year. $1 million goes into the LLC, and you got business partners. All right. However many business partners you have, you're going to do K1 distributions based on their partnership interest or how much they are going to take as a distribution. Sometimes they may not take any distribution. Other years they may only take a small amount, But whatever that number is, whatever that amount is, it goes on a 1040 form, tax form, right? It has to be filed as income, goes on a 1040 form, and that is based on your Social Security number, right? Now, the other business partner is an entity that is a business trust. We call it a business trust, and that's also going to get a K1 distribution, all right? Now, if you only pay yourself $40,000, which is what I do, out of that $1 million, let's say $1 million goes in, paid all the expenses, you got $1 million left over. You distribute $40,000 to yourself, or let's just call it for simplicity's sake, $100,000. So $100,000 goes on your 1040. You take some of the child care deduction, you take some normal standard deductions possibly, and you pay tax on whatever that money is. All right. So you take $100,000 as income. Let's do that. $100,000. And that goes on your 1040. The rest of the money, 900 of it, goes in a K1 and goes to your business trust. And that business trust is a business partner, okay? So it's a separate individual. These trusts are considered individuals or people by the Supreme Court. So when you're talking about the business trust here, it's a separate person. It files a 1041 form. All right. Any taxable income would go on the 1041 form, and it has a separate EIN number, which makes it a separate entity, a separate person completely. All right. You're going to be acting as the trustee of that trust. So you're the fiduciary of all that wealth, all that money. So when 900,000 comes in, you may have certain bills that the business trust is responsible for. Those expenditures are based on what the business trust owns in terms of assets. So if the business trust owns the building, for example, then it will pay for the building. If there are cars or fleet vehicles that are part of the business, then those would be paid for out of the business trust expenditures. All right. If it's insurance is an asset of the trust. Any money going in is an expenditure using pre-tax dollars going into the account. And then, of course, when you take a policy loan, that's tax-free money because it's a loan, not income, right? It's not considered money or income, sorry. All right. So expenditures come off top. Whatever money's left over would normally be taxed. And so that's where the game gets really fun. That's where we distribute. You as the trustee, you're the manager of this trust. You get to dictate what you're going to do with that cash. Any leftover money, you can do one of three things. You can keep it in there and pay taxes on it. That's at the highest tax rate, 37%. And that'll go on in 1041, and you'll pay 37% tax. Okay? Or you can distribute it. As soon as you distribute that money and you get it out, it's no longer in there, right? So there's no more tax due. It eliminates the tax bill. You distribute that money through just a standard distribution to your family trust. All right, now your family trust does the same thing. Family trust files a 1041 form, has a separate EIN number, and you pay tax on that money if it's left over in this trust. Okay? You are going to be the acting trustee again. Your wife or your spouse or your partner or whoever can be a co-trustee, co-chair, or co-trustee. Your children, any children that you have, will be junior trustees or what we call successor trustees. When you pass away, they'll step up into the trustee position of the family trust, and no assets of the family trust will change hands. And so right away, there's no estate tax, there's no probate costs. All of that goes away just by definition, because the rules of the game say that you can designate who the successor trustees are going to be, who the successor managers of this trust will be. Remember, you don't own the home that's in the family trust. You don't own it personally. The family trust owns it. You're just managing it. You're the steward of it. You are the fiduciary of the trust. Any cash that's in corpus, same thing. You're the manager of that money. It's not your money, right? Any expenses that come along with it, like insurance or health care, education in some states, and that's state by state, so you got to watch that, okay? In the state of Texas, you can deduct education. That's an expenditure of the trust. So we deduct that. But in other states, you can't. So insurance, we use life insurance and accumulate cash value in the life insurance because it's an expenditure going in. It's a deduction to the trust. And then when you use policy loans, those loans are never ever recorded anywhere. It's not considered income. It's just a loan. So it's never recorded, and you can use that money to pay for your mortgage if you wanted to, or you can use it to pay for education if it's not a deduction in your state. And now you've captured the deduction and paid for the education. All right. Any remaining money that's left over, this is where we consider this corpus. We deem this or designate this money, this extra cash, we call it corpus. And corpus just means the body of the trust. And so the reason we call it corpus is it becomes an asset of the trust and it's not taxable. It's not considered income, which is taxable. It's now been moved to corpus, which is an asset, and all assets are not taxable. All right. You can do that, or you can also do another thing. You can donate that money to charity. And the charity we always recommend is your own 501c3, your private foundation. Okay, because that foundation is a 501c3, it's tax exempt. So you file a 990 PF form. PF stands for private foundation, and it has its own EIN number, separate and distinct. So it's a separate entity, or by definition, according to the Supreme Court, it's a separate person. Okay? And this entity, any money that goes into it is now tax exempt. All right, there are other rules of the game that you have to play by that are important. But because it's a 501c3, any assets or any money that's generated in this entity is tax exempt. All right, so this is a donation. It's not a distribution. It's a donation. And so sometimes you'll donate money, sometimes you won't. Sometimes that cash will just go to corpus to be used for future investments of the trust. That could look like future money going into life insurance if you want to. All right, that's what we do. That's what I do personally. Life insurance is an asset of the trust. I can put aside that capital and put that money in next year, the year after that, the year after that. And it's not considered a taxable asset. All right, that's it. That's the structure. It's that simple. There's nothing more to it. We file forms with the IRS every year. The reason that you have an EIN number is just to state to the IRS that you promise you're going to file a form every single year and pay your taxes for that entity. All right, if need be. Same is true with your 1040 form, with your Social Security number. That's just how the IRS and the government tracks your taxes and in your payment of taxes. All right. The private foundation files a 990-PF form, and any assets that are inside this form are tax-free. All right. It could be anything. All right. There are different rules of the game that you have to follow every single year. You have to use 5% of that capital or those assets, whatever they've appreciated or grown to. You have to use 5% of it for expenditures or expenses of the trust, or donations or gifts or grants to other 501c3s or other entities. All right. But other than that, that's it. If you have any questions, let me know.